As people are entering the workshop, we'll go ahead and get started. As you know, you're all here for our, I guess this is our third Boss workshop of the spring semester, and we're going to present investing with Professor Trapani. Just to go through our team from the library, I am Professor Ann O'Reilly. There's also Professor Liz Jardine and Nelson Maldonado. From the Business and Technology Department, many of you know Professor Jennifer Arroyo and Professor Javier Serna, and from Social Sciences, Professor Nitu Kashik. Just to some things you might want to know, some netiquette, if you will. If you could please mute yourself and turn your camera off during the presentation from Professor Trapani. We'll take questions at the end of the presentation, but you can post your questions in the chat throughout the workshop if you so desire. We're recording this presentation, just so you're aware of that. That's why we're asking everyone to mute themselves and turn their cameras off. There's going to be a sign-in sheet that we're going to be pasting in the chat. So if you could please sign in to the sign-in sheet, that would really help us. And if you're using someone else's device to watch the presentation, if you could, I said put your real name in chat, but actually you're able, I think we'll be able to do that on our end. Please make sure you change your name so that we can identify your actual name. And then to find out about our upcoming workshops, please be sure to, and we'll keep posting this in the chat as well, our MoneyBoss website, which is at guides.laguardia.edu/moneyboss. That not only has our upcoming workshops, but it also has all kinds of fantastic information. Professor Jardine actually created that website, and she did a fantastic job creating it and does a fantastic job of keeping it updated. All right. Now I'm going to stop sharing my screen, and we're going to welcome Professor Trapani, a business and technology professor who's going to take us through today's workshop on investing. Thank you so much for joining us, Professor Trapani.
Oh, it's my pleasure to be here, everyone. So for those of you that don't know me, I am Professor Trapani, part of the Business and Technology Department. I teach the finance classes at the college. I'm very passionate about not just investing, but actually helping individuals. And that, when I say individuals, I mean people, everyday people, middle class, people just starting out, students specifically, how to really think about growing their wealth over a period of time. Now, I know that many of you probably in this room, I see we have about 66 participants, are probably have different levels of experience with investing. I get it. So I'm going to go through some things, try to address lots of things, but what I'm really here to talk about today is building a foundation for successful investing. Okay. So with that said, I'm going to share my screen, if that's okay, and get started.
Yep, we can see it.
You all see my screen?
Yes.
Okay. So again, thank you all who started MoneyBoss. I think this is a great thing. I love the name. I always did. Really about taking control, right? And that's what investing is really about. Part of it is really taking control of your own life in terms of building your own wealth. Okay. Before I begin, I just want to make note of in memory of someone that is very, very special to me personally and very special to the college. And the reason why I'm making this presentation today in memory of Louis A. Luca, it is exactly 1 year ago today that we lost Dr. Luca, who is professor of speech communication at LaGuardia for over 25 years. And he has mentored many, many students and individuals, including myself, over 40 years. And he was very passionate about diversity and inclusion. Now, I will say, and he had different opinions about money than I did, and kind of used to fight about it. But in the end, he lived a great life, and it was very, very hard a year ago when this happened for me personally. So given that this presentation happened on the 1 year anniversary of his death, I just wanted to acknowledge him and just mention how wonderful he was, and how mentorship is very, very important. So find people in your life that will help move you up rather than hang out with people that kind of bring you down, right? And mentors usually do that. They want the best for you, okay? So why should we invest? So when we look at investing, let's take a look at some of these things that happened in the past. So let's look at Apple. So if you would have invested in Apple 40 years ago, $10,000 in Apple, today is worth $6,700,000. Sounds crazy, but it's true. $1,000 in Amazon stock just 10 years ago would yield $16,000 today. And that's a return of 1,500% over 10 years. $1,000 investment in Netflix 10 years ago would be worth nearly $31,000 as of April 22nd, for a total return of over 3,000%. Okay, so finding good companies to invest in over a period of time can literally make you very wealthy, as you can see here. Right now, some of us, may not really go into finance or care about studying individual companies. And if that's the case, you can invest in what's called a mutual fund or an ETF, an index fund, right? Like in the below, the S&P 500 index, which is what we call the SPX. That's basically an ETF, meaning that the people at Standard & Poor's do the work. They pick the stocks for you. You just invest in the fund. And if you would have done that 10 years ago, you would have gained 305% on your initial investment over the last 10 years. So the market over the last 10 years specifically has done well. Over the last 40, it's really made people millionaires. I mean, it's just, it's pretty incredible. So, okay, now I'm hitting the enter, and let me see here why this is not. Okay. Now, one of the reasons why it's very important to think about investing is because of what I call the ultimate evil, right? And that's inflation, okay? So you have to, and many of you who've taken business courses here at LaGuardia have learned about inflation, right? And inflation is the necessary evil because we're always going to have it. However, what it does is it eats away at our money. Okay. Now, inflation since 1980 has ran about 2.89%, right, at a compounded rate. And therefore, what does this mean? What it means is, if you look at the bottom of the screen, if you would have invested in the S&P 500 index back in 1980, today, what you see at the bottom of the screen is $8,000 is your original investment, would be worth $703,086.76 on paper. That's what you would actually see, okay? However, with inflation taken into perspective here, right, what you really would have earned is $243,000. Okay, still phenomenal return on your investment, but the fact that inflation just eats away at your money over time means that you can buy less 40 years later with that same return, right? So one of the things you want to think about when you think about investing is, how do I beat inflation? Okay, that's very, very important. Now, inflation right now, according to the Federal Reserve, is very low. Everybody has different opinions on inflation. I have a different opinion than the Federal Reserve. I think the way the Federal Reserve actually calculates inflation is a little strange, but nevertheless, it is running a little bit below 2%. The Federal Reserve says that inflation is healthy at 2%, okay? However, it's still 2% over a period of time. It's going to erode every penny you earn, and that is even when you're building wealth. So you want to beat inflation. That is extremely important. So as you can see, The number one reason why you need to learn and invest about this stuff, again, is to stay ahead of inflation. I always say you want to kick inflation in the ass, and how you want to, and one of the things that people do, and I know people that, are nervous about investing. One of the reasons is because it just seems overwhelming. All right. It's a lack of knowledge usually. And that's why we're here. We're here to obviously help increase your knowledge about investing. But when you look at savings rates, right, keeping your money in the bank, it hurts people who just are too risk averse and want to keep their money in the bank. And you can see this is the current rate, TD Bank. For anybody who has an account at TD Bank, keeping your money in what they call a TD growth money market. Okay. TD growth money market. First of all, I don't even know why they call it that, because this money isn't growing. Okay. At 0.01%. It's going to take a lifetime to build anything, let alone any wealth at all. So keeping money in the bank obviously is important. It's the first place that income goes, right? We get paid. We pay our bills from our disposable income. And then what's left is discretionary. And the discretionary income, what we do with that is we either spend it or we choose to save it. And saving is good to build up a certain amount of money, right? Obviously, you're going to hear from so many different types of people who talk about savings in terms of building a saving for emergency, obviously emergency funds, right? You always have to have something to back you up. But over time, building enough to really begin investing. Now, I know some of you or many of you are still in school. Some may be working, some may not be working. I know some of you already invest because I have conversations with lots of students, right? So everybody's going to be in a different place. But in the end, you have to save money first before you start investing. You do not want to take every penny of your income and just throw it into the market, right? That's not the recommendation here at all. Okay. So why is the market taking off in 2020 during a pandemic, right? What is happening? Well, there's a big jump in the household share of trading in 2020. So what does that mean? That means people like me and you, everyday people, are investing more, trading more stocks in the market on a daily basis. Why is this happening? Well, first of all, a lot of free trading apps are coming to the market. Robinhood, I know a lot of students use Robinhood. It's very easy to use. Use it on your phone. They give you free stock if you join, and it's a great application. Robinhood has done a really, really good job at marketing to students, okay? I think that they've done a very poor job at educating students, quite frankly, but they are a company that wants to make a profit, and they're marketing to you guys, marketing that it's free, right? Robinhood is totally free. Nothing in life is free, okay? How Robinhood makes its money is if you put $1,000 into your Robinhood account and you trade stocks, $500 worth of stock, Robinhood takes the $500 that's sitting in there and they earn money on that, okay? Like a bank earns money on the money that you deposit, right? So that's how Robinhood is able to offer you free online trading, okay? And a lot of companies have followed suit on that. TD Ameritrade, which was just bought out by Charles Schwab, they're going to be merging, okay? That is another platform that you can use. Great online tools for learning. That's also available, as is Fidelity. Fidelity and TD Ameritrade are the ones I recommend. Robinhood, if you're new, also because it's got a great application. I don't personally use Robinhood, but if you want to buy cryptocurrency, for example, which we're going to talk about in a little bit, that's the way to go, Robinhood, all right? Another thing that's going on is people have spare time. People are working from home, okay? Matter of fact, I had a call with Jamie Dimon 2 weeks ago. Jamie Dimon is the CEO of Chase Bank, and he basically doesn't really, he's not convinced that when people work from home, they're really working from home. Okay. And I happen to agree with that. Uh, and he basically said he'll call people on his team on the phone, and half the time they don't answer the phone. He's like, "Where are you?" So Chase Manhattan Bank yesterday just announced that all employees are returning back to work in July. Right, people have to get back to work. All right, and of course, in the absence of another variant and stuff. I mean, I'm sure Jamie Dimon doesn't want to put his employees at risk, right? But the more people are home, the more they can do other things when they're working, right? They're trading stocks is what a lot of people are doing. So you can see in this chart here that if you look at 2014 to 2019, okay, the household market, this is individual investors, had about 15% of the share of equity trading, 15%. That jumped to just under 20% in 1 year. That is a huge increase. So think about it. If you have this huge influx of people interested in the market and buying stocks, what do you think that's going to do to the market? It's going to create this demand in the market, right? That's what the stock market is. It's based on supply and demand. A lot of areas of the market really took off. Okay, some are completely insane. Some are completely insane, and I'm going to share some with you. But how do you invest in a company that does not produce any earnings or revenue at all? That's what people are doing. Okay. Bitcoin, I have my own opinion on Bitcoin. I know a lot of young people like Bitcoin. A lot of students are buying the Dogecoin or Dogcoin, however you want to pronounce it. But there isn't any intrinsic value to these investments. Okay, now people are doing it. Just remember, when you're doing it, you are taking a 100% risk of your money. If you're comfortable doing that, I'm not going to tell you not to, but just be aware you can lose all of your money in those types of investments. However, I do like seeing more households investing in the market, right? It tells me that the more individuals are online and investing, they're also learning more. So if you do this and you're learning more about how to do it, then that's a fantastic thing, okay? It's how I started out by trading, but at the same time, I was also learning a lot about what I was doing. And I've made mistakes, as we all have, okay, and will. So what I want to talk about is building a stock portfolio, right? The problem is we have this dichotomy. We have young people thinking that they're going to get rich trading stocks, okay? And I know a lot of students who do a lot of short-term trading, and I know a lot of adults that do a lot of short-term trading. And I'm going to tell you that, yes, over the last 12 to 18 months, people have been making money trading stocks, short-term, okay? However, research suggests that in the long term, that usually means 12 or more months, right? And maybe in this case, it'll be 2 or more years. Over the long term, 98% of people who trade stocks for the short term, and these are day traders, these are people who buy a stock and sell it a couple of days later, you cannot do that consistently in the long term. So just be aware of that, right? I'll have students argue with me saying, no, I'm making all this money in the market, and that's great. However, I always say use caution, right? It is not consistent over the long term, okay? We are dealing with a very, very strange market right now. So with that said, what I like to talk about is building a stock portfolio for the future, starting out small and building something over time. So in the future, as you get older, you have built wealth. Why is it important for later rather than now? Well, think about it. You guys are in college. You're going to be graduating at some point. You're going to be getting out there and interviewing and getting a great job, right? That's the plan for you, hopefully. Okay. So you want to get a great job. You're going to be earning income. So you're working. Okay. You're working and you're earning money. You're going to get to a certain point in your life when you want to start to slow down, right? You may just choose to retire fully. You may want to work part-time. You may want to take a chance and maybe, start a business and not work anymore, right? But you want to have something to fall back on. And these are the reasons why you want to build wealth. Another reason is for those major purchases in life in the future. Maybe you want to buy a home. Maybe you want to buy a second home or a retirement home. Maybe you want to pay for your child's college education later in life, right? These things require planning, building a plan, and building wealth for the future. Okay. So let's look at some of the examples of short-term versus long-term mindset, right? Now, believe it or not, the last 10 years of the market have been pretty spectacular. Okay. 2010 to 2020, in the last 10 years, which many of you and many students who trade stocks have only experienced what we call a bull market, meaning a very, very strong market. And that is a 13.6% average annual return every single year. Okay. Now that's compounded, obviously, average return year after year after year for the last 10 years. That is unprecedented. As a matter of fact, if we look the last 100 years of the stock market, the average return in the stock market is 8%. And by the way, this is all before inflation. Okay. Now, if we go back to 2000 to 2010, right, it was called the lost decade. Believe it or not, in that 10-year period, stocks did not perform well. Average annual return on stocks over the 10-year period was actually negative 2.72%. Okay. Now, again, this is all capital gains, meaning that it does not include dividends. If you add dividends into the mix here, the returns are actually slightly higher. Okay, just be aware of that. Dividends are great and they're very important, but I'm only talking about market performance, right? Change in the share of the price of a stock from beginning to end. Okay. Now, if I combine the two together, 2000 to 2020, I have a 9.5% average annual return. That is still better. The last 20 years have still been better than the last 100 when I bulk it all together. It's phenomenal, 9.5%. Okay. At a 9.5% rate of return, okay, if I use a really simple formula, which those of you, if anyone's here from my classes, know the rule of 72, meaning if I take the number 72 and I divide it by my return, okay, it would give me the number of years it takes for me to double my money. So just to make it quick, if 9.5, if I round it off to 10, 72 divided by 10 means every 7 years, 2 months on average, your money doubles. Okay, that's incredible, right? Divide 72 by 0.01%, keeping your money in TD Bank. Okay, and that's going to take you more than a lifetime. You'll be dead by the time your money doubles, it meaning it will never double. All right, that's how long it would take. So that is why investing in the market responsibly, learning about it more, can really help build wealth all over time. And doing it over the long term would really help sustain those periods of time where the market may come down, right? Now, again, last 10 years, 13.6%, that's unbelievable. If you read the papers, if you watch the news, if you read Barron's, Wall Street Journal, watch CNBC, you may hear several analysts who say the market is a little frothy, to be careful. And that's why we've seen the market trading a little kind of choppy over the last month. It's been a little crazy, okay? Time will tell. Now, trading is fine. If you say, you know what, I want to trade stocks, I want to try to do this, If that's what you want to do, it's fine if it's part of your overall investment goal, meaning that, you know what, the student says to me, I have $10,000 to invest, but I'm going to take 1,000 and I'm going to use it to trade. And that's what you want to do. And I say to them, you're willing to lose your entire $1,000 and you're going to be okay with it. And they say, yeah, I'm okay if I lose it all. I want to do this. Then that's totally fine. That's up to you. But everyone's going to have their own risk tolerance. But the point here is that given that rates in the bank are so damn low, and it really hurts people who just want to keep their money in the bank, right? You have to take some risk in the market. You just have to, if you want to earn better than what you're earning in the bank. It's almost a must, okay? Now, there are ways of attempting to maximize profits by investing, but also minimizing risk, okay? So how do you start? First thing you do is, if anybody is taking management here at LaGuardia, remember the process of management? It was planning, organizing, leading, and controlling. Same idea with investing. You really got to plan it out, okay? And the first thing you need to figure out is, how much can I afford to save each month? And that's the budgeting process, right? Whether you're starting from zero or whether you have some savings already, okay? If you have some savings already, that's a wonderful thing. But even if you're starting from zero, you have to budget your money and you have to make responsible decisions about spending, right? Today in my finance class, earlier today, we had a guest speaker from Bank of New York, and he was talking about, writing every single thing down that you spend money on, even that Subway sandwich that you buy from lunch. That's how important it is to create a budget, right? And when you kind of create a budget, then you can start making some changes. Now, usually I do this with students in class where we write down everything we're spending in a month. And I get things sometimes, students spending, from $300 to $1,000 a month on discretionary items. And that means things like buying a couple of pairs of sneakers, going out to the clubs, going on vacations, things of that nature. Now, I'm not saying not to do that, because trust me, I mean, our economy depends on you guys spending money, and who doesn't love to spend money, right? However, you want to also spend money on investments. That should be part of your budget too. So how much can I afford to put to the side to save for the future? Okay. Why? Because think about it. Imagine you had just $200 at the end of the month, okay? And you bought a pair of sneakers at $100. So I chose to buy a pair of sneakers, and that's great, right? Now I go out, I enjoy that sneakers, but those sneakers have a limited amount of use for me, okay? As a matter of fact, how many of you look in your closet right now and have clothes hanging up there that maybe you bought that still have tags on them that you never even used, right? Because it's very short term when we shop. Sometimes you're just in the mood, I want to go out and shop, this will make me look good, and you buy it, and then it goes into the closet and you forget you even had it, right? It's kind of like this short-term return, right, and feeling good. However, let's look at that other $100. Instead of buying a second pair of sneakers, now I take that $100 and I decide, you know what, I'm going to invest it in a mutual fund that's returning, let's say, 10% per year. Well, guess what? Now I have that money, $100 invested, which we call capital, and that asset, that $100 asset is actually doing something for me. It's working for me. How is it working? It's multiplying, right? It's invested in something that's going to give me something back, more capital, more money that I could either reinvest, or now I have $110 a year later that I can decide to spend it on, right? So when we think about how we use money, okay, when we spend it on stuff, it's short term, it's enjoyment, right? And we should do that. However, when we think about investing, it's our asset, our hard-earned money working for us and building it going forward into the future, okay? Now, most of us can create a budget. And believe it or not, if you saved just 170, and I know some people like, I can't save $10 a month. I get it. But when you start working, or if you are working, imagine if you could just save $175 per month over 40 years and find investments that earn the average 20-year return, 9.85%, you will generate $1 million in 40 years. Okay. You can do the math, use your time value of money, future value formula, and it works out. $175 a month over 40 years at 9.85% will yield $1 million in 40 years. Okay. So if you're 20, 40 years is 60. If you're 30, 40 years is 70, right? So, and even if you are 30, it's never too late. I don't care if you're 40, it's never too late to begin investing, okay? Yeah, time has value. So the older you are, the more you have to put in if you want to yield $1 million by a certain age, obviously, okay? But it's possible. Now, what most of us or you are going to do, and I talk about these things all the time, is 401k plans, right? When you get that job at that organization, the first thing, I talk to a lot of students, I keep in touch with my students, many of them, and they'll call me and say, hey, professor, I just want to let you know I got a job, right? One of my students just called me recently, told me he got a job at Global X Advisors, right? Renzo Fazioli, one of students of mine from the past, who really worked his butt off, and finally got the job of his dreams. And I said, did you join for the 401k plan yet? He says, not yet. What? What are you waiting for? Okay, a 401k plan, or if you work for a public institution or government or school, whatever, they'll offer what's called a 403b. It's kind of the same thing. The numbers are meaningless. It's just a tax code thing. But what it is, it's an opportunity for you to put money away today for the future that's tax deferred. Meaning, imagine you have a salary of $5,000, $50,000 a year. And you said, well, I'm going to take 10% of that and I'm going to invest it in my 401k. At the end of the year, you are only going to pay taxes on $45,000. Okay. So it's almost crazy not to join a 401k because you're going to pay less taxes at the end of the year. And when it's invested, your account's going to grow, but it's not going to earn, you don't have to pay any taxes on it. Okay. Now, yes, President Biden recently came out and was talking about taxes and capital gains taxes, right? But he has said and promised that it's only going to affect people who make over $1 million a year. Okay, $1 million a year. So very wealthy people will have to pay more capital gains. Okay, everybody's going to have a different opinion of that, right? But in the end, for most of us, the 401k plan is the fastest way to grow your wealth over time. I've seen people do it all the time. Okay, people in their 50s, even in their 40s, who really were very, very strict about planning and put money into their 401k. Now, here's the crazy thing. Remember the $175 per month over 40 years? Well, guess what the IRS allows you to put into your 401k annually? You ready for the number? $19,000 a year you can put away into a 401k plan. Now, obviously, a lot of people aren't going to be able to put $19,000 away into a 401k plan when you first start working, right? But imagine you got that dream job and you got you got a job that's paying real well, like $100,000 a year, and you were able to do it. Do you know how quickly $19,000 is going to turn into $1 million? A lot less than 40 years, okay? Even less than 20, right? So if $175 a month is going to yield $1 million over 40 years, imagine what $19,000 is going to do. Now, again, most people, we say max out in their 401k later on in their careers when they're obviously earning more money. Some people aren't able to do it. But what if you're able to just do, $5,000 a year in your 401k? That is still going to accumulate rather quickly over time. And what the 401k is how people get to retire, right? Now, people put into their 401k, but they also create other plans where they invest in stocks on their own. You can do both later on, right? But remember, if you're starting at zero, you start small and you build up over time, right? In my class today, our guest speaker, Alberto, said that he had zero when he came over to America from Argentina. He had no savings and stuff. He started from ground zero. I started from ground zero, okay? My parents were immigrants. They didn't really know about investing and whatnot, although they were good savers and keeping their money in the bank, but they never really learned a lot about investing until later on in life when I learned about it and tried to share it with the family, right? So, I started out ground zero as well and learned and built my portfolio over time. And trust me, if I can do it, you can do it. Okay. And I know that some students are doing it today because I talk to many, right? So it's important to be disciplined, and that's the key, and stick to your plan. Don't worry about the day-to-day fluctuations of the market. As a matter of fact, you know what I tell students, and they think I'm nuts? I tell students, you want the stock market to go down, right? And the reason why you want it to go down is because even if you're in it already, because if you bought Apple at $130 a share, and it goes down to $100 a share, you have an opportunity to buy more of Apple at a lower price, right? So net, your average cost decreases, okay? Now, if Apple goes to zero, yeah, then that would suck, but Apple ain't going to zero, right? But usually what happens is sometimes things correct and then they go back up, right? Now, Apple is reporting earnings, I think tonight or later this week. So obviously when companies report earnings, there's always going to be some action with the stock in the market, okay? Organizing. Now, once you create your plan, the next step is to organize your investments to determine what is the best asset allocation. So like I said earlier, if you have $10,000 to invest and you want to allocate $2,000 to risky assets such as cryptocurrency or some new industries, or $4,000 toward a combination of different stocks and good fundamentals, or in a diversified portfolio, that's fine. But do not put your money on all the Wall Street bets picks. I know you all know what Wall Street bets is. You're all hearing about that through Robinhood, or other social media or YouTube financial gurus, okay? These guys really piss me off, right? Maybe some of them are real, I don't know, but when I hear people coming online and they're talking about a stock, trust me, and they have a lot of followers on YouTube, they already bought that stock. So by trying to get it out to their followers, if you go ahead and buy it after they already bought it, and another 10,000 people go ahead and buy it, guess what? It's going to pump the stock price up. Then they can sell it, make a huge profit in your stock. And that's exactly what happened with GameStop, okay? GameStop, all right, I got to be honest with you. I don't really know much about the company. What I know about them is that they're a retail brick and mortar place where you go and you rent games. I know that they're trying to get into the online arena, right? Creating games online and doing competitions. And if that's the case, that's wonderful. However, if you look at this chart, just back in October 28th, okay, not even a year ago, right? This stock was hovering at about $15 to $20 a share. Okay, it was even less, right? And then all of a sudden it went all the way up, and you don't want to buy it right here in the middle when it was $300 a share. I know a lot of students who, were buying it at those high levels and then took a beating, and the stock took a beating and went back down well under $100 a share, and then started to get pumped up again by all the social media, by all the talk, by all the news organizations and whatnot. And right now it's $177 a share, okay? You've got to do your own research though. Now, just looking at one metric, okay? It's one metric I look at, right? Is the company selling stuff? What are they doing, right? Well, let's look at the total revenue. If you look at this company's income statement, okay, for the last 4 years, in 2008, they generated over $9 billion. Not bad, right? But look at the trend. The trend from 2018 to 2019 to 20 to 2021 is down, meaning this company is bringing in less revenue. Why the hell would you buy a stock in a company whose revenue is deteriorating? That is a heads up. Like, what is going on with the company? Okay. Now, there's lots of things going on, right? Especially the fact that they're brick and mortar and everything pretty much is online now. Okay. So, unless this company has something incredible coming out, right, we haven't heard about yet, then I would say, well, maybe it's worth the 177, right? And we'd have to look at a lot more metrics. But just on revenue alone, it's absolutely insane. But why are people buying it? Because of social media, pump and dump, we say, people talking about it online and everybody jumping into the bandwagon, right? Very, very, very risky move.
Professor Trapani, I just wanted to point out that we have about 15 minutes left of the workshop.
Yeah, I'm almost done, and then we're going to open it up to questions. Okay.
Great.
So
Thank
some
you.
of the things that we're going to talk about, I'm not going to get into these, but these are the things that you should, again, if you take the finance class, we learn about them more. But what I do want to say is it's a great time to invest. And the reason why is because things are changing in the world. A lot of opportunities are coming our way, right? Yeah, we've had this coronavirus. It really brought us down. I mean, it's going to change everything. But when everything gets back to normal, wow, we are going to see an economy that's going to be so brand new with so many new things happening. A, it's going to create a ton of jobs, right, and opportunities for young people. And B, I think that the next Apple, Amazon, Netflix, Starbucks, they're out there. You just got to find them. You got to do your research, right? So what can you do? Mutual funds, ETFs, there's thousands to choose from, right? These make it easy on you where you don't have to really think. They do the work. The companies do the work. They put all the money in a bucket of different types of investments, okay? ESGs, these are a new thing that they're becoming very, very popular. And this is about people investing in things that they care about, okay? And ESGs obviously stand for environmental, corporate governance, and social responsibility, okay? ESGs, environmental, social responsibility, and corporate governance. These are things that people care about doing the right thing. So there are a lot of companies that are focusing on this area that are creating mutual funds and ETFs if you want to invest in those types of things. Cryptocurrency isn't going away, right? Bitcoin, although it has no intrinsic value, it's all supply demand thing. I know Elon Musk is buying a lot of it, and that's why it's been pumped up. But the technology, the blockchain technology is here to stay. We're going to see more and more of it. It's still evolving, right? There are opportunities, but again, it's very risky because they're still evolving, and there's going to be so much more competition come into play and regulation, and that can really take effect and hurt the prices of some of these cryptocurrencies. SPACs, what the hell are they? This is a new idea that's been created to take money away from the big investment banks, right? And these are special purpose acquisition corporations. These are companies that are set up, right? They raise all this money, millions and billions of dollars, whatever it is, and then they go shopping. So they're also known as blank check corporations, blank check companies. So meaning that they raise all this money and then they decide, well, what industry do we want in? Where do we want to invest in? Okay. And the people who manage the business are the people who make the decisions for the investors. All right. These are new. We've seen a lot of them last year and more to come. And then you've got the evolving industries. You've got the electric vehicles coming. They're coming. You've got hydrogen as an alternative fuel. You've got robotics. You've got AI, artificial intelligence. I'm telling you, this is happening all in the next 5 to 10 years. Our world is going to change. If you think that the iPhone really changed lives, and it did, it made a huge difference, this is going to be nothing compared to what's coming in the next few years. And with that, it's going to bring lots of opportunities for investing. Okay. How do you do it? Again, TD Ameritrade, Charles Schwab, Robinhood. You can go online to starttdameritrade.com. You can take a picture of that if you want, and it can walk you through on how to open up an account. There's no charge, no fee to open up a brokerage account. However, you won't be able to purchase anything until you make a deposit, like you make a deposit at the bank. That's how you get started. Okay. And overall, in the controlling piece, just make sure you're sticking to your plan, right? Some people say, I'm going to put $100 a month into my investment account, and then they stop. That's bad. You want to stick to your plan. You want to measure whether or not your investments are more risky or not, okay? Are you diversified? Can I increase my contribution to my 401k? These are some of the things that you want to think about to stick to your plan as you start to see your wealth grow over time. Okay. And I think, last thing. How much do people have in their 401ks right now saved? Okay, these are the real numbers as of the fourth quarter of 2020. People aged 20 to 29 have about $15,000. This is the average. Okay, so this is in the middle, the average, right? Obviously, there's 50% more people that have a lot more than this and 50% who have less, okay? But the average is not acceptable, right? If you go to age 50 to 59, $203,000 might sound like a lot of money to you guys today, but it won't be able to sustain a retirement over the long term, right? So the average isn't good enough. We need to obviously shift that upward. And why is that? People don't start saving until later in life, and that causes a problem because you can never reach your target point, that 1 million, if you will. That's gonna help, right? So here's a guide. This is going to be recorded, but by age 30, you should have at least 1 year of your salary saved. Going all the way to by age 60, you should have 8 times your annual salary saved. So by 60, if you make $100,000 a year, you should have $800,000 saved in a retirement account or 401k or what have you, okay? My top investment pick for 2021, best investment is you. Invest in yourself, right? By getting an education, you're going to be able to get a quality job that's going to pay higher than the obviously average salary, okay? Practice the skills, really truly learn, and go out there and be the best that you can be. Because quite frankly, believe it or not, back in 2010, when Warren Buffett talked to a bunch of Columbia students, he said that he would pay $100,000 for 10% of the future earnings of any of you, any students who do really, really well and get a job. Why? Because the research shows people with college degrees get good jobs and over time increase their skills and earn money. And Warren Buffett was willing at that time, jokingly, obviously, to invest in the future earnings of students. So invest in yourself first, okay? Go to college, get a degree, get that great job, open that 401k, create a plan and make it work, all right? That's all I've got, folks.
Oh, Professor Trapani, thank you so much. That was a great workshop, and I'm sure everyone's really appreciative of it.